This is Chapter 14, Discussion Number 3, Banking Services. So how do banks serve the everyday common customer? Well, banks need money to loan out. So the way that they get money to loan out is that they encourage you to put money in the bank with savings accounts. Not only savings accounts, but they also offer the idea of checking accounts, that you can easily take money out of the bank without necessarily being in the bank. Checking allows people to withdraw from their accounts, and then that money is then transferred from one bank to another. Some banks also offer overdraft protection in case you write too many checks out. For example, banks will offer to automatically withdraw money from your savings account to cover the amount of the check. Sometimes that's limited to how many times a month you can do that before they start charging you. Different banks have different policies. Also, banks may also offer to extend a line of credit to cover the check. Now, this line of credit is essentially an automatic loan, which means there's probably interest attached to it. This is things that you want to make sure that you're aware of before you start opening a checking account at various banks, of what exactly their policies are and how they deal with these circumstances. Some banks will charge a service fee on your checking. Some of that may be determined on how much money you have in the bank or how much business you do with the bank, that they have different rates for different types of customers. Again, these are things that you want to check out when you open an account with the bank. Now, banks also offer loans. That's how they make their money. They loan money out, and then they charge you interest on mortgages, house loans, car loans, home equity loans. All of these ideas are, how banks loan out money. Now, you probably are familiar with what a mortgage loan is for a house or for land. Car loans, that's pretty self-explanatory. Want to make sure you understand what home equity is. Home equity loan is if you want to borrow from the bank against the value of your house that's already paid off. So, for example, let's say that I buy a $100,000 house and I've been paying for several years, and I have $80,000 of the house I own. The rest is owned by the bank. Well, let's say that I want to borrow some money. So I say, okay, bank, I'll give you $20,000 back of the value of my house, and you'll give me $20,000 that I can spend. That's a home equity loan. Of course, they'd charge me interest on that $20,000, but that's what home equity means. Also, banks, especially in this modern era, have electronic funds transfer. ATMs are a big example of that, of how they get money. That you're not at the bank, but they will make sure that your money gets from your account to where you are. Also, electronic cashier's checks from one bank to another is another way that money can be interchanged between banks without actually having to get an armored truck in order to get money from one point to another. They also offer internet services. Some banks also allow you to pay bills online. There's also the idea that some banks offer Notary Republic. Some banks have separated parts that help you perhaps invest your money. It is, according to legal law, though, that the bank itself cannot help you invest your money. They do have to have a separate enterprise, mainly because, remember, back in the 1920s, banks were playing with people's money on the stock market. When the stock market fell, a lot of people lost their money, and the government said no more. Banking is not allowed playing with their depositors' money. So those are some ideas of what banks do for customers in the business of being a bank. This concludes discussion number 3, banking services.